Hi everyone and a good evening. You're watching The Money Show on ET Now. I'm Ubina Kapasi. This is the show dedicated to your personal finances and your money related questions that I'm sure all of you always do encounter. Well, guess what? This show is dedicated to answering them, so shoot them to us. Our email address is themoneyshow@etnow.tv. Let's tell you what we have lined up on today's episode of the show. All of 2021, we on The Money Show have been focusing on one thing, and that's diversification. So we'll continue with that topic, but this time around we'll be talking about how to diversify your credit risk in your portfolio. Shweta Jain of Investography will be joining us in just a very short while from now, so stay tuned. And yes, of course, she'll answer your questions and queries as well. Later on the show, we will be then talking about the big run-up in Bitcoins, but also the big fall in gold prices. What's more, the RBI, meantime, has tightened payment security norms for better security and privacy for people like you and me who use digital payments. And finally, in our Spend with TMS segment, of course, we have to talk about travel. Lots to talk about over there, not just because of the new COVID strain that has spread, unfortunately, especially with the big spike in Maharashtra especially, but also with the tweaks in the airfare cap and whether it's too soon now to plan a summer holiday. We'll be bringing on board MakeMyTrip.com to talk about that. So an action-packed day, but before we go any further, let's take a look at the headlines. Markets end the week in the red with pharma and auto stocks coming under selling pressure. However, PSU banking stocks emerge as the big winners in this lackluster week. PSBs rally more than 10% this week and broader markets outperform the benchmarks. Gold starting to lose sheen this year after ending 2020 with a bang. The gold rally seems to have hit a hurdle. Prices are down 7% so far in 2021, making it the worst start for the yellow metal since 1991. It's raining exclusives today. ET now learns that the government will file an appeal against the Kane Arbitration Award soon as it aims to protect the sovereign right to tax entities under its jurisdiction. It's an ET Now impact. Sources say Punjab National Bank may be mulling an exit from its stake in PNB Housing. The lender may be in talks with PE investors for selling its 32% stake in the housing finance arm. That's yet another ET Now exclusive. A big milestone as India crosses the 1 crore milestone in vaccination. But the country has also reported its biggest jump in new coronavirus infections in 3 weeks. States of Maharashtra and Kerala remain a cause of worry. Dr. Reddy's initiates application with the DCGI for emergency use authorization of its vaccine candidate Sputnik 5. As part of the review process, Dr. Reddy's will present the safety profile of the Phase 2 study and interim data of the Phase 3 study, which is expected to be complete by the 21st of February. Well, those are the headlines that we'll be tracking for you all evening today on ET Now. SIP accounts, meantime, have hit a record high. This despite the fact that we have been seeing net outflows from mutual funds month after month, as reported by AMFI. But account registrations rose to 16.4 lakh in January. We caught up with Nilesh Shah of Kotak Mutual Fund, tried to understand this rise in phenomenon. And he says that it's not only urban India who've got onto SIPs, but also rural India as well. Listen in.
Month-on-month, mutual funds have kept on adding new SIP account net of cancellation. And from roughly about 3.11 crore accounts, we have now moved to 3.56 crore accounts. So every month we are hitting new high in terms of SIP registrations. However, due to COVID-19, we have seen drop in average SIP investment value. The peak SIP monthly contribution was about 8,600 crore in March 20. Now it is roughly about 8,050 crore. So there are a couple of observations. SIP was earlier domain of middle income to rich people. Now it is becoming acceptable solution to bottom of the pyramid also. Mutual funds are facilitating this by starting SIPs of 100 rupee also. Second, earlier SIP was more semi-urban and urban concentration. Now it is spread into rural India also.
All right. Well, that, of course, was Nilesh Shah. And yes, it's finally encouraging to see that SIPs are back in traction. In fact, last month's AMFI number as well said that the average SIP flows are back to above 8,000 crore rupees, a figure that was lagging under that level for obvious reasons, for the last couple of months as people struggled with COVID and the kind of problems it brought about. Well, let's get back to, our topic for today, and that is diversification. As we've been telling you all of 2021, if 2020 was about risk-taking and if you had the gumption to take on that risk, you definitely would have scored well in the year 2020. But 2021 is all going to be about diversification. We are seeing a variety of asset classes do well, some of them not doing well as well. But the aim of the game is essentially to get the right mix of assets into your portfolio and ensure that you are not too heavily concentrated in one asset or one investment style. So keeping in mind with that, we decided to talk about credit risk. This is something that we have struggled with quite a bit in the past, even with the most surprising of assets really. So hence we decided to talk about this. Shweta Jain of Investography joins us now on the show. Shweta, hi. Thank you for joining us on the Money Show today. It's always a pleasure having you with us. So to start with, Shweta, why do you think it's important for somebody to assess their credit risk in their portfolio? What is it exactly? And actually, let me rephrase the first part of my question. Is it even something that retail investors like me maybe need to even know about?
So absolutely, Mubina. I think credit risk is one of the most important things to look at in a debt portfolio for the simple reason that when we invest in debt, the idea is to invest in safety assets to make sure that our money is safe. So we have to make sure that the money is absolutely safe and there is no credit risk in the portfolio. So when we talk about risk, I think in any debt portfolio, we have to look at three kinds of risk. One is a liquidity risk, the other is a credit risk, and there is the interest rate risk. So credit risk, where it is, to simplify it, it's the safety, where there is no chance of a default. So it's very, very important to assess this in one's portfolio.
Okay, so that one thing is established that you must know how much credit risk you're carrying in the portfolio. So how can one do so, Shweta? I mean, what assets would be considered as something that's having a high credit risk in your portfolio or is contributing to that much riskiness in your portfolio? How would one assess that? Is there a numerical value or is it qualitative? Because sometimes it's obviously, no, all the time, in fact, it's always a little more difficult to interpret anything that's qualitative. So how do you recommend retail investors start about with that?
To start off with, we can see what the backing is. So generally, say a government-backed security is safe. One could also look at rating by credit rating agencies. So something like a AAA rated security would be the highest level security or the highest level sort of safety, so to speak, in any kind of instruments. So one has to make sure that when you're investing, you're not just looking at the returns that you're going to make or returns that the fund has made in the past, but what kind of risk the fund is taking to generate this return. So what is the quality of the portfolio? Where is the portfolio being invested? So what is inside the portfolio is far more important than just what the outcome of the portfolio has been.
So every debt fund, Shweta, would have a rating by, a credit rating agency like ICRA or CRISIL?
Absolutely.
Okay, all right. So they will basically do the tough job of, getting into the details of the fund and, seeing what's the credit worthiness of each of these. So you really don't have to worry about, going into the nitty-gritties of that. You'll have these credit rating agencies, who will do that tough job for you. Now, when we consider...
there will also be upgrades and downgrades through the month.
The safetiness.
So one has to make sure that you're tracking that as well. So you have to track it a little bit. You just can't invest it and leave it, because you have to make sure that the credit risk that you signed off for is the same sort of level has been maintained throughout as well.
Okay. So it's something that's not stagnant. Obviously, it's continuously evolving. So you'll have to ensure that you keep track of that. There is a possibility that, a debt fund may have gotten a bit more adventurous and taken on a bit more risk in their portfolio. In that case, the credit rating agency will then accordingly tweak their fund rating to reflect the same. So like Shweta said, that, you'll have to keep monitoring at least that bit of it. Now, by the way, Shweta, keeping that in mind, we also have this new riskometer that has been introduced by, SEBI. I think from the 1st of January onwards, it has been introduced. So since we are talking about this, why don't you talk about this whole riskometer that has been introduced, as it is in action currently? How is it looking? How can retail investors as well use that riskometer?
So when we look at debt funds, the riskometer basically talks about these three parameters: the credit risk, the liquidity profile, and the interest, the duration. So how long the duration is. Because the longer the duration is, the higher the volatility will be, the higher the chances of volatility is. So you have to make sure that you're reading all these when you're looking at the riskometer. The idea is to evaluate the risks based on these parameters rather than just as a category. So investors are aware of the risks that they're taking when they're investing. And not just, just looking at a category and saying, okay, if it's a credit risk fund, every credit risk fund has the same kind of risk. It could be a credit risk fund and still have AAA rated funds. So that's what this riskometer will help you sort of see and evaluate.
Okay, understood. All right. So it all the more makes life easy, I suppose, for a lot of our viewers. Now, if I have to talk about all the fixed income or the debt assets that are out there, and the entire category and the umbrella of debt funds out there, Shweta, how would you essentially rate in terms of credit riskiness of all the fixed income assets?
Okay, so credit riskiness, just based on credit riskiness, I think we look at like a government securities fund first as being the safest. In that also, there'll be two categories. There'll be short-term government funds, and there'll be sort of long-term government funds. So these are GSEC funds or gilt funds, as we call them. So the short-term are obviously more safer because the interest rate risk is also not there. And then there is the long-term sort of gilt funds. Then there are the ultra short funds, which are high risk, which are safer, all AAA rated funds, but which have higher liquidity and lower sort of tenure will come in your lesser risk profile, and then definitely your long-term sort of funds.
Welcome back. You're watching The Money Show on ET. Now we're in conversation with Shweta Jain, talking about the ways that you can diversify, check and assess the credit risk in your portfolio. Shweta, just before we went into break, I was actually asking you about the credit riskiness of a fixed deposit. I wouldn't have asked you this question 3-4 years ago because, for us, fixed deposits has been that one traditional place of investment where, my interest rate is written in black and white, and of course it's a bank. So, I am going to get my money back at the end of that fixed deposit term, be it 1 year, 3 year, 5 years. But now, of course, we've seen all these instances. PMC Bank, of course, the most prominent one. LVB and Yes Bank were at the brink, but luckily the RBI, with its proactive moves along with the government, managed to find an efficient resolution. So the depositors were safe from all the despair that PMC Bank depositors, unfortunately, are still going through. So would I be correct in saying that today maybe even an FD would carry a certain amount of credit risk depending on which bank or institution you bought the FD with?
Absolutely, Mubina. I think a few years ago, we would keep asking people if they knew FD was insured only till about 1 lakh, and people actually did not know that. And last year, when there was this WhatsApp forward of HDFC Bank that came, and saying, oh, it's only up to 1 lakh, after which it was increased to 5 lakhs. And we've been recommending clients and investors for the longest time now that they don't go by rate of interest in these FDs. So, for example, they shouldn't be tempted with the extra return that somebody is getting them, but they should be looking at how safe it is. So look for bigger banks, look for maybe public sector banks, even divide the FD between 2-3 banks. Although that's not necessarily it's not going to safeguard you, because totally 5 lakhs per PAN will only be the insured amount. But still, it's, making sure that you have your sort of diversification, which is the theme for you as well. But yeah, making sure that you divide it into 2-3 good banks and big banks.
Okay. So right now, would you recommend that, stay away from cooperative banks and rather go for one of those tried and tested SBI, BOB, HDFC, Shweta? Is that something that you would advise clients as well right now?
Absolutely, absolutely. And cooperative banks, we've been telling people no for quite some time now, for the simple reason that I've seen people, even before it became news, there were smaller banks where people would be refused to even give their savings bank account, and they would stand in line for days to just withdraw small amounts. So definitely, we would not recommend cooperative banks. We would not recommend that they go with smaller banks and get tempted with sort of higher rates. In this category is supposed to be safe, so let this be safe.
All right. Okay. Fair enough. So, Shweta, how can one reduce the credit riskiness of their overall portfolio? Like you mentioned, many a times if one of the credit rating agencies believes that, okay, a particular debt fund has suddenly taken on board a lot of credit risk, and they accordingly tweak their rating on the on that fund. So when that happens, how can I essentially reduce the credit riskiness of my portfolio? What investments can I include to sort of balance it out?
So you can invest some of the safer fixed sort of investments like PPF, NSC. I know they're sort of boring and old school, but you can add these to your portfolio. You can add some gilt fund to your portfolio, even some corporate bond funds with AAA rated securities, whose mandate is to only invest in highly safe options and opportunities, and not necessarily where they go down the credit scale. But like always, there is a trade-off, though. The lower risk you'll take, there is limited liquidity, there is lower returns, or there might be both. So people have to sort of balance this and do what works for them, do this trade-off that works for them.
All right. Fair enough. All right. And Shweta, very quickly, actually, I wanted to ask you on what your thoughts are on this announcement by the RBI on opening a gilt account directly with them. Do you think that's something retail investors could do? Because you're essentially buying government securities directly, effectively from the government.
Definitely, retail investors can look at this as an option. But like I said, there are trade-offs, right? So you have to choose if you don't want diversification, because they may not be able to choose too many sort of securities for this. They may not be able to diversify across the time line. So they may not be able to buy bonds of various tenures, which happen in a gilt fund. Also, there is transactional cost. There will be some of that they'll have to sort of handle. And I would only recommend this for investors who are looking at 3 to 5 years, and not something which is sort of short-term in nature, because all said and done, there will be some volatility even with government securities funds as well, if you look at it in the short term, especially the longer duration ones.
Okay. Okay, time for questions and queries from our viewers then. And our very first question is from Datta Sita. He asks, I would be getting around 80 to 90 lakh rupees on my retirement, which is due soon. I will also get enough pension for survival. Kindly suggest the best way to invest across schemes and how to bifurcate this amount scheme-wise. Shweta, what would you recommend?
So I would then assume that this money is for wealth creation and not necessarily, for their survival, because they mentioned that. I'd recommend still a 40-60 allocation between equity and debt, because you will want to sort of beat inflation over time. and what pension they're getting today will not be sort of adjusted for inflation later. So IDFC Short-Term Bond Fund, 15 lakhs, Aditya Birla Corporate Bond Fund, 20 lakhs, IDFC Government Securities Fund, 15 lakhs. I would also recommend some bit in a bank FD so that there is that liquidity available. And this is sort of a comfort factor for most people as well. So 5 lakhs in a bank FD, ICICI Nifty Next 50 Fund, 10 lakhs over a time period staggered. PPFS Flexi Cap Fund, because this would give them some bit of international diversification also. And ESP Quant Fund, 10 lakhs. So this also gives them some sort of passive funds as sort of a core and some international diversification. So I've tried to make sure that they keep their eggs in different baskets, not in the same basket. So, yeah.
All right. Okay. So that's, of course, the view coming in there. It's a big sum. And, since you already have your pension, which will help you survive, this money can be used to tackle the dreaded inflation monster, which is, of course, seen in almost every area of spending that we do today. Let's take on board our next question. Sridhara Narukavil writes in, please advise whether one can invest a lump sum in equity savings and balanced advantage fund. Kindly recommend some of these fund names. So he's not exactly written the purpose of choosing these two categories of funds, but he wants to know whether he should do a lump sum. Information is a little incomplete, but yeah, Shweta, in general, what do you think of these two categories of funds? What purpose or investment objective do they help fulfill?
So I think balanced advantage category is a fantastic category for somebody who doesn't want to keep sort of reallocating their assets and reviewing their asset allocation. So you decide what kind of asset allocation you want, a band, and you choose that fund. Having said that, lump sum in these is absolutely fine even now. Again, depends on the time horizon and the purpose of investment, because these will also, these could be volatile over time depending on how much equity they have invested and what time they've sort of entered. But they could look at lump sum in these funds. I wouldn't recommend that it has to be only in like a systematic way. Lesser equity funds like the equity savings fund, definitely a good idea. Something like a Kotak equity savings, Aditya Birla balanced advantage and ICICI balanced advantage fund could also be a good sort of recommendation for them.
All right, understood. Great. Well, I think that's all the time we have. Shweta, thank you so much. It's a pleasure, as always, having you with us on the Money Show today. And folks, if we've not been able to take your questions, don't fret. Just email them to us and we'll get them answered. A very short break on the show. When we return, we'll be talking about the returns that some of these asset classes have given us. And of course, our ET Now Insight as well. So don't go anywhere.